Well, to remain timely, we're going to go ahead and transition over to our next presentation of the day, which is on the next generation of accelerated underwriting, hearing from Sean Conrad and Dan Bouchard. Sean is a vice president of pricing, pricing actuary at Hanover Re. He's based in Charlotte, North Carolina, and responsible for pricing and client consultative activities related to various life markets, with a focus on alternative underwriting opportunities, which include predictive modeling, accelerated underwriting, and automated and digital processes. Sean's career spans 20 years in the life insurance and reinsurance industry, including 3 of those working in the UK and Irish markets. So with that, Sean, I'm going to go ahead and turn things over to you. I can see your screen, which looks great, and let you take it away.
All right. Well, great. Thank you for having us. We're excited to be able to share with the Actuarial Club of the Southwest. And since probably a lot of the attendees have seen a number of industry presentations on accelerated underwriting or discussed it internally, Dan and I thought we'd try to take a different approach with this session and talk a little about how accelerated underwriting has evolved over the last few years, and then also where it's going. So during the day, during the session, we'll talk about accelerated underwriting, also automation, predictive modeling, and then how the expanding universe of third-party data is helping risk selection, especially in a digital process. So before I jump in, thought it would be good to provide a little background, and I always like to start with a level set and provide a working definition of accelerated underwriting, because it can mean different things to different people. And so for the purposes of what we're talking about today, when we talk about accelerated underwriting, we're talking about a triage decision of who to order examine labs on. So using that non-invasive information, the application disclosures, third-party data like pharmaceutical history, motor vehicle records, those sorts of things that are available non-invasively, often in real time, to be able to decide, am I ready to make an underwriting decision on that individual? Am I going to accelerate them? Maybe I already know enough that I'm going to decline this risk, or do I need to do additional underwriting? Whether that be referring that case to an underwriter for manual review or ordering additional underwriting requirements, like an examine lab or an APS or other sorts of medical records. The other piece of background I wanted to provide was just a little about what Hanover's role has been in this market. And I do this not to advertise Hanover, but just to give some background on what data and experiences we're pulling from. So accelerated underwriting has been an area of focus for us. We've got 25 different accelerated underwriting programs that we're a part of, some of which have been in existence for over 8 years. And so that's a lot of experience and learning and data that we're able to pull from. And they cover a wide variety of different program designs, distribution channels, target markets, et cetera. So we have a lot of data to be able to pull from, to share insights. So with that, I'll hand it over to Dan, who's going to talk a little more about the evolving landscape of accelerated underwriting.
Thanks, Sean, and thanks for that introduction. To start talking about the next generation, I actually want to reflect on where we've been for a half second. If I think about a lot of underwriting in the underwriting industry for the last 30 years, many of which predate my time in the industry, I think of stagnation in terms of overall philosophy around risk selection. I think that was a trope for like 30 years, that the life insurance industry hasn't really changed. And then came along accelerated underwriting in the middle of the 2010s. And then if you think about the amount of innovation that has come since accelerated has started about 7 or 8 years ago, and then has really exploded since the start of COVID in 2020, which is hard to believe. That's over 3 years now. Really, it's just innovations coming up everywhere. And I like to use the phrase, innovation is starting to breed more innovation. With that innovation comes opportunity, opportunity to improve your risk selection, opportunity to improve your customer experience. And if we think about what the next 5 years of accelerated underwriting is going to look like, it's not going to look like the last 5 years. It's going to continue to evolve and continue to innovate. And as someone who gets to play in that sandbox every day, it's quite exciting for me because kind of everything that we uncover is a new thing that could lead to the next piece of innovation. But it really is, it's quite fun to work through and uncover some of these challenges. If I think through some of the biggest things that have changed over the last couple of years, when you started out with acceleration, it used to be age 45, max age 50, usually up to 500,000. Now table stakes, age 60 is eligible for acceleration, maybe age 65. $1 million face amounts are pretty standard in the industry. Some companies are pushing 2 million, some companies are pushing 3 million. Really rapid expansion in that area. When the first accelerated programs used to be just preferred plus or best preferred. You take that small sliver of your best risks at best preferred, you would accelerate those. Now you have a full complement of risk classes, and even some companies are starting to go down into the mild substandard. So really a expansion of what we're offering to consumers. Third-party data expansion, I'm going to touch on this a lot more in a little bit, but the amount of third-party data and vendor data that we have on our applicants now has really taken off, and it really provides some exciting opportunities for risk selection. But where we were even just pre-COVID to where we are now, it doesn't even compare. EHRs, electronic health records, and the enigma that those are, I separate those from third-party data just because I think they're still developing in our industry, and everybody says that they're the future of risk selection. I think in 5 years from now, we still may be saying that they're the future of risk selection, not the present. But I think they're worthwhile mentioning and monitoring in the evolving landscape. Tele-interviews, kind of moving towards the thing of the past. We're moving towards more of a digital application, making it easier for the consumer to interact with us. Even you go directly to something like a direct-to-consumer company, definitely applicable there. But I think more and more traditional companies are starting to move into, kind of a more of a digital process, which also leads to more automation. I think at Hanover, we are a firm believer in automation, kind of driving the next level of innovation. And so kind of moving to more of an automation process for risk selection and underwriting definitely will be on the landscape now and in the future. And then probably one of the more exciting, scary, nuanced buzzwords is predictive analytics in our industry and the role that predictive analytics can have in overall risk selection. As someone who's built over a half a dozen models in production now, the potential of predictive analytics is immense. But as a good comic book says, with great power comes great responsibility. And predictive analytics is definitely a role for that. I wanted to level set with automation because it's going to be at the kind of the bedrock of everything that I talk about going forward. If in a manual process, humans are at the center, human thought process, human rules, the internal thinkings of a human in terms of risk selection, it's a human is at the center, and that's a process that can take days or weeks to do underwriting. Automation, if you look at the inputs, they're the exact same. We're not throwing some fairy dust over it. An automated engine is just something that has automated rules with the same inputs to make automated decisions. But instead of a process that takes days or weeks, it takes seconds or minutes. And that ability to interact with your consumer in seconds or minutes really opens up a really nice frontier. Digital footprint and the available data is something that has become a really big focus for us at Hanover over the last couple of years, really brought on by the expansion of the amount of data that we see, and that the hit rates from these data sources has continued to climb. So if you think pre-COVID, you'll definitely have prescription histories, you'll definitely have financial-based information, and you'll definitely have motor vehicle-based information. When I think through the first accelerated programs, that was pretty much what was the core foundation of available data that you would get. If I think about what we have now, you have clinical lab data, you have medical claims data, you have criminal histories from a multitude of sources that you can gather. These three data sources, I would say the digital footprint on our applicants has more than doubled, close to tripling. If I think about in 2018, 2019, how many times I would have a significant amount of information on a consumer, it's usually just coming from prescription histories. Now I can get it from prescription, from clinical lab, from medical claims, sometimes all three, sometimes two of three. And that really, what I call the digital footprint, paints a very strong digital footprint. But we used to think that no news from a risk selection standpoint is good news. I can pretty much firmly say that no news is not good news and most likely bad news. Your cone of uncertainty around risk selection when you don't know anything about a consumer is quite wide. I mean, how many 45 or 50-year-olds don't have any prescriptions, don't have any lab work done in the last 7 years, don't have any doctor's visits in the 7 years? When you start painting it like that, it's a very small subset of people in America that fit that profile. And so ultimately, no news means we're probably missing something. And that has been a drastic shift for us in determining that we really want to go after the people that we know a lot about. And those are the people that we want to accelerate rather than the people who slip through because we didn't find anything on them. Data is at the center of everything here, and the ability to capture high quality digital data, whether it's from our vendors or from applications or an automated engine, that really is driving a lot of the insights and innovation that we have. This was great because we were able to look at applicant disclosure for two very similar companies in similar target markets, similar distribution. Would have expected the same disclosure, except for the fact that the question wording around marijuana was two very different concepts. You'll see in program A, the question was very straightforward. It was, when was the last time you used marijuana? Program B, when was the last time you used cocaine, heroin, narcotics, barbiturates, amphetamines, hallucinogens, or cannabis? So very negative connotation with the use of cannabis there. Program A, 10% disclosure. Program B, 3% disclosure. So over 3 times the amount of disclosure coming from just asking the question in a way that makes sense from a behavioral science perspective. Why does this matter? Disclosure will always lead the way. Even though third-party data is expanding and providing a ton of value, third-party data is a complement to clear and concise application questions. If you have proper disclosure, you can do things like reconcile. You can look for consistency in trends. When we talk about predictive models, consistency is a huge thing that goes into predictive models. But if your applicants don't understand the question they're being asked, that's a huge problem. Now transitioning to predictive analytics, and I'm gonna spend a little bit of time here because I do think it is the wild west of accelerated underwriting and has the most room to be explored in the future. For any of you who work in risk selection, you will have seen a model at some point. There are just so many models, so many scores, so many different things that vendors are trying to push, and they all have utility and value in and of themselves, and how they interact should be your really big focus. If I think about the types of models, you have models that can predict an underwriting class, you have prescription history models, you have triage models, which at Hanover is our preferred method of model to determine whether or not someone's going to be accelerated. If it's a 1 or a 0, if it's a 1, they get accelerated. If it's a 0, they go down full underwriting. You have financial models, which are very common in accelerated underwriting now. Medical claims, kind of a mortality-based medical claim model, newer kind of in 2023, but also already getting significant traction. You have distribution models, propensity to buy models. You have underlying mortality models. You have smoker non-disclosure models. So, and if I think about the industry over the next 5 years, there's 8 models here. I would bet there's going to be 16 models in the future as predictive analytics continues to expand. For you, I would really focus on how these models interact. As someone who's built a triage model, mortality models are an input into my model. And let's say there's a neutral score from a mortality model. Well, if underlying that neutral score of the mortality model is a very limited digital footprint, then my triage model actually is going to assume that is a bad thing. because it goes mostly on the digital footprint. However, let's say my mortality model has a significant amount of data and credibility and footprint behind it, my triage model is going to give a lot more credibility to that mortality-based model and kind of the band that that model paints. If I think about what a predictive model is and kind of just an overview of an acceleration predictive model, one of the big things, especially in our regulatory environment, is the inputs to the model are identical to the inputs of the underwriting process. It is the application disclosures, your third-party data, but you use those things in a way to produce relationships like your digital footprint or whatever it may be. You have your predictive model, which is your underwriting algorithm, and the data science, for me, is actually the easiest part of this whole thing. The data scientist community is very well established. These algorithms have been tried and tested through Kaggle competitions or whatever they may be. And so the data science part is actually the easiest part of my job as a model builder. My focus really comes in on understanding my inputs and understanding my outputs, which in this case is just a simple auto decision accelerate or RTU. This is a very similar visual to the automation visual, but instead of a computer, it's an algorithm, or what I attempted for a photo of an algorithm to be. Same inputs. The algorithm is attempting to do something very similar to what a human underwriter is attempting to do. They're attempting to look at the information around them and determine, do they have enough to make a triage decision, or do they think there's enough risk out in the tail here that warrants going down full underwriting? The mechanisms, the data inputs are all the same. They're both multivariate in nature. One is just using the human brain, and the other is using AI. So really, why predictive models? It's a little bit of complexity, does have a couple drawbacks, and really every time that we've implemented a predictive model, we've seen huge efficiencies in overall risk selection. The data that we're able to look at and the data that we're able to build models on is able to tell us a lot of things about the underlying risk profiles of applicants. Example is the digital footprint. This is actually a common example that we've had with a number of our partners. Let's say you have a program that age 50 and 500,000 of acceleration. They have an acceleration rate here with a correlated mortality slippage. They want to expand to age 60 and 1 million. Well, you're going to increase your acceleration rate that way, naturally. You're going to go to this green dot. However, you're also going to increase your risk profile. Generally, that age 50 to 60 movement is going to have slightly increased risk. And so you're also going to increase your mortality slippage. Increase in acceleration is great. Increase in mortality slippage, not so great. And maybe you say you price the product to only have this level of mortality slippage. That brings in what we call the efficient frontier, which is essentially just 100 different dots and different points from the predictive model that you can use to do let in different amounts of risk. And so if you wanted to keep the exact same mortality slippage, you would move down to where we intersect here, and you could accelerate the same amount of people at a significantly lower mortality slippage. Let's say you wanted to keep your mortality slippage the same. You would move all the way over to here. You can now accelerate a significantly larger, greater percentage of applicants for the same mortality slippage level. So really you get that optimal efficient risk selection, and we've seen this time after time again, just because multivariate risk selection by far exceeds a simple rule-driven risk selection. Speaking of rules, predictive models are great. They do not take care of 100% of the risk selection problem. In our risk selection programs, predictive models and automated underwriting rules complement each other. Predictive analytics, predictive models are really great at evaluating 85 to 90% of the gray area, kind of that middle with positive and negative signals. However, any underwriter will tell you there are going to be one-offs, whether maybe it's a diagnostic code for terminal cancer that under no circumstance you would ever want to accelerate because they would break the math of your mortality slippage calculation. And so the complement of rules and predictive analytics really goes hand in hand. if you built a predictive model that picked up on 2 instances of extreme declines, you would have a model that would be overfit. And so you don't want to have a predictive model that has the ability to find your outliers and your one-offs, because really it's going to be an overfit model and it's not going to be useful in the future. As exciting as predictive models sound, there are a significant number of challenges that go with predictive models. And these things are not trivial, but I think they're worthwhile exercises to go through, and they actually do make your risk selection stronger. I will say evolving tools, and this is popping up a lot. We have a number of carriers as our partners who are looking to add clinical lab data to their risk selection paradigm. At the same time, they're also looking to implement a predictive model where their training data or their historical data does not have clinical lab data as part of the risk selection process. And so how do you have a new tool and historical data, and then how do you ultimately produce risk on an ongoing basis to meet your pricing target? And that's where I'm not going to give away all the secrets here. I would say definitely talk to us. We're more willing to have that conversation offline, but it varies from carrier to carrier, but that's where we've done this a number of times. There's a number of ways you can go about it, and you can meet your targets. Evolving behavior. I'll give a good example. We had a group of people that were not historically accelerated, and they went down traditional underwriting path historically, and we had all this data on them, and the data on them looked quite promising. Looked like it would fit our pricing targets, and so we made the decision to expand our acceleration criteria to include them. What ended up happening, the predictive model ended up really liking those people because the historical data quite favored them. The historical slippage on them was quite strong. The behavior of that group of people changed significantly because we added the option for them to go down an accelerated path, which brought a little bit more anti-selection and a little bit more adverse behavior that our training data was not captured on. Now, fortunately, with the predictive model, it's easy enough to just tighten our overall threshold a little bit, move down that efficient frontier a little bit to accommodate that behavior, but monitoring and evaluating that behavior is going to be a big challenge to any predictive model. Expertise. It's no small thing to say that predictive models, especially triage predictive models, it is not a data science exercise. It is an underwriting exercise. Understanding the inputs, understanding what they mean from an underwriting perspective is far more important than any technical work you will do with an algorithm. And so when you build an algorithm, you have to have half an underwriting hat, half an actuarial hat, half a data science hat, half a legal hat, half a customer behavior hat. You need a lot of different hats while you build this model. And so one of the better things that we've done at Hanover is we brought all those skill sets into the same roof. So I can have these conversations with an underwriter, a data scientist, an actuary, all within the same day, all within the same hour. And really that has helped me build my models through that underwriting lens. Whenever anybody hears an algorithm or predictive analytics, they think black box. You think there's no way for us to explain these decisions granularly, and everybody's just going to have to get comfortable that the model's doing what we say it's doing. And ultimately, that's just a load of crap. As someone who's built a model and someone who explains models to distribution or underwriters, you need to be able to get at the granular level of why the model is doing what, whether it's univariate or multivariate. The data typically has all the answers. It's just on you to explore that data and to provide those answers to whoever is looking for them. Cross-pollination of skills, I'll say that goes hand in hand overall with your level of expertise. Data collection. This is becoming less of a big deal now because I think every company is now collecting data in some digital fashion, which makes it much easier to build predictive models. But there was a long period of time in our industry where data wasn't readily captured digitally and wasn't available for analysis. And that ultimately what these predictive models are built on is data. And so you need that data, whether it's from your own internal experience or a reinsurer's experience. You need that data from a historical perspective and also an ongoing perspective, so you can make sure you monitor and evaluate any predictive model or any program to that extent that you have in production. Communication. when you throw in a predictive model and a little bit of that black box element, you talk about explaining why someone wasn't accelerated to an agent, or explaining to an underwriter why their digital footprint is the reason why they didn't pass the predictive model. Those are new conversations for those people. And so giving the proper audience the proper training on what this tool is doing is extremely important. I would say this tool has so much value only to the extent that you can communicate it. And then finally, regulation. I think depending on what different states are doing, a lot of this is still up in the air. We are monitoring closely. It is too early to tell which way this will come out. The wind is still shifting directions, but we are definitely on top of it, and stay connected with your reinsurance partners and your vendor partners, because they're going to be the ones that are as close as possible to it. Because as we start trying to implement things like triage predictive models, there is a fair amount of overlap there. And with that, I'm going to kick it back over to Sean to wrap it up with monitoring.
All right, thanks, Dan. So one of the things we're strong believers in is the importance of monitoring and management. And Dan talked a lot about how the accelerated underwriting space has evolved. And I think a big part of that is because of the learnings and the data and the monitoring. You know, as you get more comfortable with certain risk profiles, you can expand acceleration, expand automation, those sorts of things. But at the same time, you also identify pockets of risk that you want to pull back on, or that you need to tighten around. And so the data and the monitoring and management, they serve a purpose both for risk management as well as process improvement. One of the reasons it was really important to have monitoring is it's going to take years and years for credible mortality experience to develop. So we thought it was important to have those leading indicators of business quality, of mortality, so that you could learn quickly, adapt as needed. And then the other thing that's important about monitoring is the reporting and the feedback loop, getting that information in front of the subject matter experts and the key stakeholders, the people who have some ability to manage the levers of the program, so that you can help steer in the direction that you want and you need to go based on what you're seeing in the data. In terms of monitoring tools, one of the most important metrics that we look at with accelerated underwriting programs is the mortality slippage, is what we refer to it all as. Is, how much higher is mortality going to be because of the accelerated program? The fact that you're waiving examine labs or other underwriting requirements on a subset of cases means there's going to be some increase in mortality. And so looking for tools that help us to quantify that and monitor it are really important. Two of the most important tools that we use, and we highly encourage any insurer to use at least one of these, many use both, are the post-issue APS, which essentially means after the case is underwritten and issued, you order a APS, a attending physician statement, to identify whether there was any non-disclosure additional risk that wasn't captured in the original underwriting decision. A similar approach for trying to capture what might be slipping through is the random holdout. And for that, you can think of it as, this is a case that would have otherwise gotten accelerated, but they were selected as a random case to go ahead and put through the examine lab testing. And you're looking to quantify what did you miss? And you think of those, because they're random, as a representative sample. So both of those tools are commonly used. We're also starting to see programs that use electronic health records as part of that post-issue monitoring. And then companies that also use RX, pharmacy history, or medical claims, rechecks, kind of ordering 3 or 6 months post issue to see if there were any developments. And then MIB Plan F is another tool that provides information that might help you identify non-disclosure or anti-selection. So using these tools, you're going to want to quantify the mortality slippage, and we use the confusion matrix to quantify this. And really, what the confusion matrix is it's looking at that underwriting decision or that risk classification based on an accelerated basis, based on only that non-invasive information. And then you compare that to what would the underwriting decision have been with the additional information, whether it was the examined labs of a random holdout or the APS of a post-issue APS monitoring case. And to the extent that those two decisions are the same, there was no mortality slippage, and that's represented here by the green diagonal. The underwriting decision would have been the same on an accelerated basis as it would have with additional information. But it's those places above the diagonal when the risk classification with the additional information would have been worse that generate the mortality impact or the mortality slippage. And in particular, it's the big misses illustrated here in the red, the tobacco non-disclosure, the rated and declined cases that slip through that are really going to drive the mortality impact. And that's the leading indicator for where you'll expect mortality to ultimately emerge, as you start to generate credible mortality experience. So it's really a question of what's the frequency and severity of the misclassification from the accelerated program. So as part of our programs, we collect this data as part of the monitoring process. We now probably have 100,000 or more of these APS or random holdout monitoring cases. So we've developed some good benchmarks around what do we normally see, what would we expect to see in a well-performing accelerated underwriting program. And the big takeaways are the vast majority of accelerated cases have no slippage. It's typically 80 to 90% of the accelerated cases will not have any difference. We'd categorize them as accurate. There was no adverse findings in the random holdout or APS data. Most of the time, programs don't have much where the accelerated program's more conservative, but there are programs where the fully underwritten process has crediting criteria or health credits or those sorts of things. In those situations, you can have situations where the full underwriting decision would have been better than accelerated, but in most cases that's pretty minimal. Another takeaway from what we've seen in the data is that the majority of misses are small. Mostly one class misses. The next biggest is the 2 to 3 class, but the majority or most of the misses are going to be fairly small in nature and they have a mortality impact, but it's relatively minor. So we really focus on those big misses. Typically see less than 1% of the accelerated cases would have been a rated case that slipped through. Declines even lower at less than 0.5%. And then from a smoker non-disclosure percentage, typically in the 1 to 3%. Although we have seen that start to creep up over the last year or two. I think as acceleration rates have increased and probably as customers and producers have become more aware of accelerated programs, they've become more prevalent and maybe better understood. I think there has been some change in behavior that's contributing to that increase. So we wanted to share some benchmarking information. At the extremes, we've seen mortality slippage on accelerated cases be less than 10%. And in other cases, it's been greater than 50%. But the key is ensuring that mortality impact is consistent with pricing expectations. Just because it's higher than the average that we might see doesn't mean it's a problem if you went into that program design and product pricing expecting higher slippage. Some target markets, some age groups, et cetera, you're likely to have higher mortality slippage, and so you want to price for that. We've also seen companies that have consciously gone into their program development saying, we want to have a high percentage of accelerated cases, and built more mortality slippage into the process. In terms of the slicing and dicing, having a lot of data is really helpful. Being able to look at things by gender, and pretty much across the board, we tend to see more mortality slippage for males than females. Not surprisingly, mortality slippage tends to increase by age. Certain distribution channels have higher slippage. Certainly digital direct-to-consumer programs tend to have a little more slippage. But the other thing that we're starting to do more of now is look more granularly. Dan mentioned the digital footprint and some of the new data sources. Looking at signals that we're seeing in the data, and you do see more mortality slippage on those cases that get accelerated where limited information. We're also seeing more slippage in cases where there's been a lot of insurance activity. MIB has an insurance activity index, and we're seeing negative signals around cases that have done a lot of shopping. And so I think this is all going to feed into the next generation of accelerated programs of automation and of predictive modeling. So to wrap things up, accelerated underwriting has evolved a lot over the last few years. A big part of that is the automation and the digitalization of the underwriting process and the application process. I think one of the exciting things that those two things are creating are opportunities for new markets, new distribution, ways to economically target and serve what have historically been underserved markets, and make it more economical to distribute life insurance to younger ages and lower face amounts. And so I think that's one of the exciting things that accelerated underwriting and automation are going to enable going forward. So with that, we have some time to open it up for questions.
Excellent, and thank you both. Just as a reminder to everyone on the call, please put any questions that you have into the chat box. That will help us to manage those questions and keep them ordered. And I'll go ahead and kick one off in terms of my own question. Dan, I think you had mentioned at one point the importance of consistency in predictive models in the context of disclosures and information that's being disclosed. Is that a concern at all when it comes to the consideration for third-party data? And here I'm not a medical expert, but was just interested if there are potentially ever conflicting signals between something like the prescription history and medical claims. And maybe this is a question about matter of technique, but are there concerns or protocols that need some attention in predictive modeling with respect to consistency of data when it's being sourced across from different third-party platforms or applications?
Yeah, it's a great question, and allows me to talk about one of my favorite examples. Our chief medical director, his background is in psychology, so he's done a lot of work with anxiety, depression. I've kind of latched on to him and became an amoeba in terms of learning as much as I can about that stuff. And what you'll see is you'll have very specific question wording around, do you have anxiety? Do you have depression? Do you have bipolar disorder? Very specific diagnoses. What you end up seeing in, let's say, the RX data is you'll see anxiety and depression medication, but it's someone who thinks they have high stress, or they go on an airplane and they take something, a Xanax, to go on an airplane. but that shows up under anxiety medication. If you say, okay, this person has 6 fills for Xanax, and they said no on the anxiety question, that's non-disclosure. That's all, they're lying to us. But what actually, and that was when I first built my predictive model, that was the first thing I did. And the predictive model spat it out and said, you built me a crap feature. You built me a feature that doesn't do anything in terms of predicting, because I was jumbling true non-disclosure with much less severe non-disclosure. So ultimately what I had to do in that process, and this just comes from mining third-party data and mining different conditions, is develop what I call severe non-disclosure, definite signals, definite patterns, and tie that back to your consumer information, plug that into a predictive model, all of a sudden predictive model loves it.
Yeah. The other thing I'll add is we're seeing more programs use third-party data to ask additional reflexive questions. So going back to the customer and saying, you did not disclose, anxiety, but we see this medical claim or this prescription. Can you provide more details? And essentially give them a second chance to disclose. Maybe they forgot, maybe they didn't know that applied, maybe it was a poorly worded question, but essentially give them an opportunity to help fill in the gaps and really do that in an automated way, so that the underwriter doesn't have to go back and ask follow-up questions through the agent or try to order additional medical records to try to put the story together, but get it firsthand from the customer.
That's interesting. Yeah, very good. Appreciate that. A few questions coming in via the chat. One of those about the rules and how agents have understood them. Question says, traditionally agents understood the rules and held you to them. How does that work in the new paradigm? Do agents know what's going to push them into an additional underwriting instead of approval or decline?
Yeah, I think when I think of some of the most successful programs, accelerated programs, they've done a lot on the front end and ongoing around communication and training for agents and staff and just kind of throughout the organization. But ultimately, I think it's the benefit to the agent, the consumer, and to the insurer, to help them to understand what sort of risks are going to be good candidates for acceleration versus not. So field underwriting guides, certainly making them aware of what ages and amounts are eligible, so that they don't submit a case thinking there might be eligibility for acceleration that won't. And then I think, so I'm a big proponent of helping them to field underwrite and understand the rules and the importance of disclosure and all those sorts of things. And then things like the random holdout help you to protect yourself a little against them just trying to steer through, those rules and non-disclosing things that might have gotten kicked out. So Dan, anything you'd add?
Yeah, I think our experience is that agents who get good disclosure know what the outcome is going to be most of the time. The third-party data and predictive algorithms, they're not really going to find something that's not there. But if you have an applicant who is a diabetic and doesn't disclose it, the third-party data now more than ever is going to find out the rate 1C, and they're going to get kicked out of the program or offered a substandard rate. And so really what we found is that it keeps distribution honest to a degree, because we do have a number of tools to find non-disclosure. But really it comes down to, if you have applicants who are admitting the right things that line up with their history, there's never been an issue. But it's when those two things disagree is when people start to fall out of the process and get kicked to full underwriting and not acceleration.
Very good. Appreciate that. Another question, how is the regulatory landscape evolving? Does it vary by state?
Yeah, so it's definitely evolving. I'm part of an ACLI group that's been focused on unfair discrimination, especially around race and through the use of algorithms and predictive models and AI for the last couple of years, and just thinking about how it's evolved over those 2 years. And initially, it was a group that was put together to kind of proactively try to get in front of it. And then you had the Colorado Department of Insurance pass some regulation or legislation, and then work on regulation around that. And so, over the last probably 12 to 18 months, it's been much more reactive to that, while still trying to influence and provide feedback to other states that might be providing it. But it does change quickly. I think later this week, there's a call with the Colorado Department of Insurance, a stakeholder call to get comments and feedback on their latest draft of the regulatory landscape. I don't know where everything's going to land, but I think it's safe to say that there's going to be a need for more documentation, more governance, and probably more testing in general around the use of some data sources and use of predictive models. Now, where you draw the line on, what requires testing and what requires documentation, I think those are the sort of things that are still up in the air. I think directionally, there's going to be more of those three things.
Okay. And a third question, do you model on human underwriting decisions? If yes, do you also evaluate based on comparison to human underwriting decisions?
Short answer is yes. Long answer is I tend to view slippage, especially in an automation world, in two facets. One is slippage due to automation. So under the same requirements where an automated engine makes a different decision than a human would looking at the same requirements. That is slippage due to automation. The other part is slippage due to acceleration, which is when you take away that additional requirement of fluids or an APS or whatever we used to call full underwriting. And really both of those are mortality slippage. For a triage model, we're agnostic to where the slippage comes from. And so generally, we definitely tend to focus on slippage due to acceleration. That's where most of our data points come in from. And almost all slippage due to acceleration does have that automation component. But yes, most of the reviews that we do have that human for the post-issue APS or the random holdout.
And I'll add, if we had more mortality data, the idea would be to build models on the actual mortality, but it just takes a long time, and you need a lot of data to be able to accumulate enough deaths to have credible models on that. So we look to the human underwriting decision as our proxy for what we think that mortality is going to look like.
Appreciate that. All right, well, last call for any of the attendees to put a question in the chat box if you want that question answered. And as I'm not seeing any new questions come in, Dan and Sean want to again extend appreciation and thanks for your being here today and presenting on accelerated underwriting. Yeah, it was quality conversations. And one last question: do you use credit data in the modeling or accelerated underwriting?
Yeah, I think that's a good example of all the programs being different. There's a good percentage, probably over half of the programs that we participate in that use credit data or kind of credit related mortality scoring tools. But then there are others that don't. Some never have, some have done it at times. So it really is a variety. And then when it comes to predictive modeling, we're using what data is available. So some of them would use credit data, but if it's not available, it's not a requirement.
And any potential regulatory concerns for using credit data if it's used?
So I think that's a great example of one of those things that we're watching closely to see how Colorado and other states end up defining their regulation and kind of the terms of what needs to be tested. So we're prepared to do that, and I know some of the vendors have already done testing around their tools and are starting to share results, showing that their algorithms are not unfairly discriminatory. But ultimately, we're waiting to see where the regulation ends up and then reacting to what will be needed.
Okay. Well, Sean and Dan, thank you so much for being with us today.
Thank you so much.
Thank you.
All right. And to everyone else that participated, thank you for calling in. And we look forward to talking with you tomorrow. Take care.